Welcome to this explainer for May 9, 2026. We're diving straight into what has literally been a week of high-stakes drama in the global foreign exchange market. If you follow global finance, you know things have been kind of predictable lately. Well, scratch that. This week completely shattered that calm with wild swings, shifting policies, and massive state interventions that caught a lot of traders completely flat-footed.
Here's our roadmap for today. First, a market of diverging currencies. Second, the yen intervention crisis. Third, the core drivers of that intervention. Fourth, policy meeting market reality. And finally, what to watch next.
Section 1. A market of diverging currencies.
Okay, to really grasp the sheer scale of this disruption, we first have to look at the baseline divergence pattern that set the stage as the week kicked off. Generally speaking, risk sentiment totally overshadowed safe haven demand. Because of that, non-US currencies broadly strengthened, leaving the US dollar as the weakest major currency across the board, bar none. Meanwhile, the euro kind of underperformed its peers, trading in this very narrow, low volatility range. And the British pound? It showed a mild upward bias, though it was definitely capped by that pre-election political uncertainty over in the UK. But look at the top of that pack. The Australian dollar was the undisputed leader here. Why? Well, on Tuesday, the Reserve Bank of Australia aggressively hiked its benchmark rate to 4.35%. And this wasn't just a one-off thing. It marked their third consecutive hike. It's a bold, hawkish move, especially while other central banks around the world are actively considering pauses. This aggressive stance really solidified the Aussie dollar's fundamentals and drove it right up, with the New Zealand dollar following close behind.
Section 2. The yen intervention crisis.
So, while the Aussie dollar was climbing steadily on the back of traditional monetary policy, a massive shockwave was about to hit the Asian markets and steal the spotlight entirely. What actually disrupted the forex market this week? Spoiler alert, it wasn't a standard central bank rate hike. It was a direct, heavy-handed official intervention that completely shattered the market's expectation of a one-way street. Japanese authorities stepped in practically out of nowhere. After facing severe downward pressure, they absolutely smashed the unilateral expectations of yen depreciation, violently pushing the currency to a 10-week high of 155.04 per US dollar. Guys, this wasn't just a minor market correction. It was a highly aggressive, engineered reversal. Now, to really understand the sheer speed of what happened here, look at this. During the Asian trading session, the yen surged a staggering 1.8% in a mere 30 minutes. Just let that sink in for a second. In a market as highly liquid and incredibly deep as the foreign exchange market, a 1.8% move in half an hour is literally an earthquake. Mapping this out, you really have to notice the tactical brilliance, or, ruthlessness, depending on your positions, of the timing here. According to Reuters, the official intervention kicked off with direct yen purchases in early May. Then, authorities specifically took advantage of the thinner trading volumes during Japan's Golden Week holiday. They caught traders completely off guard while they were away from their desks, engaging in 4 consecutive days of buying. This coordinated state effort effectively trapped speculators who were betting against the yen. That sudden 30-minute surge we just talked about, it triggered a massive short squeeze, accelerating the rally even further as traders panicked to cover their positions, pushing the currency to its strongest level in over 2 months. We even have some institutions eyeing a target of 150 per US dollar now.
Section 3. Core drivers of intervention.
So why did Japan feel compelled to take such drastic action right now? To understand the motive, we have to look at exactly what Japanese authorities were fighting against: the global carry trade. You can think of it like borrowing free money from your neighbor to put into a high-yield savings account across town. Because Japan has kept interest rates so incredibly low, traders have been relentlessly shorting the yen. They're borrowing it on the cheap to fund investments in higher-yielding currencies elsewhere. And this created a really dangerous depreciation spiral, making the yen the global market's absolute favorite asset to short over the past year. The actual engine driving this is an extreme structural divergence. On one side, you've got the US Federal Reserve, which has hiked aggressively and maintained high rates for 2 straight years. And on the exact opposite side, you have the Bank of Japan fiercely clinging to an ultra-loose monetary policy with historically low rates. This widening US-Japan rate differential is the exact mechanism that made the yen the primary funding currency for those massive global carry trades. Ultimately, the intervention was triggered by 3 core factors. First, the yen was nearing a major psychological tripwire, that 160 per dollar level, which blatantly breached the government's policy red lines. Second, as we just saw, that structural monetary divergence had gotten completely out of hand.
And third, the government realized they needed to shift from simple verbal warnings to concrete action. They had to demonstrate unprecedented official resolve to defend the exchange rate floor on a massive scale not seen since 2022. I mean, state interventions of this size and severity are incredibly rare.
But, why does a weak currency actually matter to the everyday person in Japan? Well, because a collapsing yen accelerates imported inflation. Suddenly, filling up your gas tank or buying groceries just skyrockets in price. This severely disrupts domestic consumption and threatens broader economic stability. The state simply had to step in and intervene to protect domestic consumers from prices spiraling totally out of control.
Section 4. Policy meets market reality. So what happens when aggressive state policy meets overwhelming market momentum head-on? What we witnessed this week was a classic David versus Goliath scenario. You had Japanese authorities trying to single-handedly break the unilateral trend of global carry trades. They were throwing immense capital into the market to forcefully reverse a consensus expectation that had been building for over a year.
But Japan didn't do this in a vacuum. They actually chose a practically perfect window of opportunity. They were aided by a highly conducive external backdrop. Broad US dollar weakness provided the perfect cover for their moves. Plus, easing geopolitical tensions in the Middle East boosted global risk sentiment. So the dual impact of direct state intervention combined with organic US dollar weakness created the perfect storm, leading to the extreme yen volatility that dominated the entire week.
Section 5. What to watch next.
So, what does this all mean for you and the markets moving forward? As the dust settles, there are three major focal points you need to keep your eyes on. First, U.S. non-farm payroll data. This is going to be absolutely critical in shaping future Federal Reserve policy and the overall direction of the U.S. dollar. Second, watch the upcoming Bank of England rate decision, which will definitely influence the pound. And most importantly, gauge the likelihood of further Japanese intervention. The market is undoubtedly going to poke and prod to test Japan's resolve and see if this new floor actually holds.
And that leaves us with a really high-stakes question to ponder as we wrap up this explainer. Did Japan just permanently rewrite the rules of the global carry trade, successfully introducing a massive new variable into the Forex ecosystem? Or was this unprecedented expenditure of capital just a brief intermission before the market inevitably tests them and the structural realities of global interest rates once again? Keep a close eye on those data points, because the answer to that question will dictate the flow of global capital for the rest of the year. Thanks for joining me for this explainer, and we'll see you next time.